When a central bank sells gold and tries to lower the gold price, it ultimately depletes the backing of whatever credit they still have by reducing the amount of gold on its balance sheet that backs those liabilities. And so longer term, selling gold weakens the credit and strengthens the gold price. Whereas when a central bank buys gold, they have to put more credit into the circulation, into the banking system in order to acquire that gold. And that weakens credit relative to gold and increases the gold price.
When central banks attempt to manipulate the gold market by selling off their reserves, the underlying credit dynamics of the global financial system shift unexpectedly. Historical data tracking central bank actions shows that heavy institutional liquidation often triggers major macroeconomic reversals rather than long-term price suppression. Rafi Farber, an Austrian school economist, posits that central banks fail to act as rational economic players in the global marketplace. Farber asserts that these institutions are merely trapped by arbitrary mathematical formulas from introductory econometrics classes rather than an intrinsic motivation to protect authentic purchasing power. Consequently, when a central bank drains liquidity by offloading its gold stock, it aggressively diminishes the exact physical backing behind its own liability notes. This institutional miscalculation means that instead of permanently depressing commodities, prolonged global gold selling inevitably weakens paper credit and strongly reinforces long-term gold prices. Looking at current global trends, any future attempts by global monetary authorities to aggressively dump physical bullion into the open market will inevitably trigger another massive multi-year gold bull run, while accelerating the systemic decline of major paper currencies. Now, we present the clips from Rafi Farber's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Central bank gold buying doesn't matter in terms of the price. I know people wouldn't want me to yada yada. Central bank gold buying, a graph of central bank gold buying and selling since 1950. So you can see from 1950 to 1966, central banks were buying gold hand over fist, and it wasn't affecting the gold price, obviously, because we were still on a gold standard at that time. Then 1966 and 1968, central banks were trying to sell gold in order to keep the London gold pool alive. Now, yes, the central bank gold selling did affect the gold price by attempting to keep gold in line with the $35 statutory rate that it was. So I'm not saying that central bank gold buying does nothing. I'm saying it doesn't really matter in the scheme of things. And then we see here that I boxed in 1974. That's the first box over here. That's when the selling started. 1973, there was no action in gold at all in central banks, in the big central banks. But then 1974, remember they changed the rule in November 1973. 2 months later, they started the gold selling. 1974, 75, 76, 77, 78, 79. That was still the biggest gold bull market in history by percentage. And it coincided with massive gold selling by central banks. And because the bottom in gold happened at the very time that central banks declared they were going to sell gold, that's when the price started to skyrocket. The gold bull market began in 2000, 2001 in the face of huge amounts of gold selling. And the gold buying only started in 2011 when the gold bear market resumed from 2011 to 2015. So really, from this chart, there's almost an inverse correlation between central bank gold buying and selling. I wouldn't say it's inverse. I wouldn't say it's a contrarian indicator or anything like that. I'm just saying it doesn't really matter in terms of price trends. Now, the question is, why would that be? There could be a lot of reasons, and I'll give you one that I'm thinking of that has to do with Austrian school logic in terms of value schedules for individuals. Now, when an individual buys gold, especially in the hyperinflationary phases of it, he's not really buying gold. He's getting rid of dollars. So it doesn't really matter to him how much gold he gets for those dollars. He's just trying to get rid of the dollar. And if that's all he can get, that's all he can get. That's in the ultimate apex stages of hyperinflation. But even in normaler times, a person buys gold because he's trying to preserve his purchasing power, because he wants stuff. A central bank, why do they buy gold? They buy gold because they want to inject the economy with a bunch of liquidity. They have to print dollars to buy gold, just like they have to print dollars or any other currency in order to buy whatever it is they're buying. And when they sell gold, what are they doing? They're trying to drain liquidity from the market. So how many dollars they get for it doesn't really matter to them. They're going according to an equation that somebody made up in econometric class 101 of how to be a Keynesian. So they're not really making a decision about their own purchasing power that they want to reserve. They're trying to manipulate their liability note. It's not really an economic actor there. These aren't people making selfish personal decisions about their own purchasing power and what they want to do with the value of the work that they have invested all of their lives to create. We're talking about econometric nerds who are going after theories or following theories that make no sense because you can't reduce human action to constants or put them in an equation, according to Austrian school logic, which is actually correct. And so the succinct way to put this is that a central bank or central banks in total are not really economic actors. They have no interest in preserving their own purchasing power as individuals or even as institutions. They're trying to rescue credit by manipulating its price relative to gold according to equations that aren't even real. When a central bank sells gold and tries to lower the gold price, it ultimately depletes the backing of whatever credit they still have by reducing the amount of gold on its balance sheet that backs those liabilities. And so longer term, selling gold weakens the credit and strengthens the gold price. Whereas when a central bank buys gold, they have to put more credit into the circulation, into the banking system in order to acquire that gold. And that weakens credit relative to gold and increases the gold price. So whether you want to look at this globally in terms of logic as an economic actor, or you want to look at it in a microscopic way as to what is the mechanism of a central bank buying and selling gold by decreasing the backing of the liability notes that they call currencies or credit, and why central bank buying gold will decrease the gold price by increasing the backing of the credit relative to money. Either way, it's about individuals assessing their purchasing power and deciding whether they can rely on the credit notes of central banks.
The historical precedent of late 1973 clearly demonstrates how public institutional declarations can spark aggressive rallies in the precious metals sector. Following a sharp multi-month correction that bottomed in mid-November 1973, a collection of 7 prominent nations abruptly terminated an accord that had barred official bullion transactions on the open free market. This sudden regulatory shift initially caused panic selling and a minor price drop in major European financial hubs like London and Zurich as traders feared a massive institutional supply dump. However, the macro reality proved completely different, and the official announcement sparked a historic 100% market surge that sent prices skyrocketing from $90.50 to nearly $180 an ounce within just 4 months. This specific historical pattern proves that declaring an intent to liquidate reserves ultimately devalues fiat currencies and causes gold values to climb. Now, let's get back to the interview.
Before we get to the Fed itself, just a review of the 1973 action in the price of gold. We topped here at about, $126. In May 1973, we fell for about 1, 2, 3, 4, 5, 5.5, 6 months at a low of $90.50. Well, according to the New York Times, it's about $86, so it's slightly below this. But this bottom took place on November 15th, 1973. What exactly was going on around that time, and specifically on that day that caused or preceded immediately a humongous 100% rally in the gold price from $90.50 to about $175, $180 just 4 months later. The bulk of this rally took place in January and February 1974. Well, the first cause, and I will call it a cause, was gold revaluation by the Federal Reserve in October 1973, a few weeks before the bottom. But why was it on November 15th exactly? Well, we'll get to that in a second. Let's read this Federal Reserve paper together and reclaim the rainbow symbol for what it should be. It is a very titillating magazine called Federal Reserve Bank of St. Louis, January 1974 Review. Let's go to page 4 in an article entitled The Monetary Economics of Gold by Albert E. Berger. You can tell he's probably a very nerdy economist who doesn't have any idea what he's saying because he's a mega Keynesian, but at least he's writing about gold. I'm not sure if he's still alive. I doubt he is, actually, because this was 52 years ago or so. So we have here on page 4 October 1973, change in the official price of gold, right? That means a gold revaluation, devaluation. I know a lot of people believe that the gold standard ended on August 15th, 1971 with Nixon's closing of the gold window, but no, gold was revalued twice after that, up to $38 and then up to $42.22 in 1973. And this was the last revaluation of gold from $38 to $42.22, and that was around the bottom in 1973. But this is gonna shock you. So, October 1973, change in the official price of gold. In the week ended October 24th, 1973, following congressional approval, the official dollar price of gold was again increased, this time by slightly over 11%. The Treasury gold stock, which had been officially valued at about $10.4 billion in the previous week, was now valued with the new official price of gold at about $11.6 billion. The official dollar value of the gold stock rose by about $1.2 billion. Okay, then what happened? The U.S. Treasury, again, as in May 1972, had a choice of actions: either neutralize the effect on the monetary system of this increase in the dollar price of gold, or monetize the $1.2 billion and use it to pay for goods and services, hence increasing bank reserves by this amount. So he's saying, if the Treasury decides to take this $1.2 billion that now belongs to the Federal Reserve and spend that money into the economy, well, then that would be inflationary. But if they don't, then it's not. Well, what did they decide to do? What do you think they decided to do? Of course you know. In the week ended October 24th, 1973, this was 3 weeks before the gold bottom of 1973, mind you, the dollar value of the gold stock rose by about $1.2 billion, and Treasury cash holdings also increased by $1.2 billion. At this point, there was no net effect on the monetary base. Why? Why is that? Because they hadn't spent the money yet. It was just an accounting entry that equals $1.2 billion more, but since that money isn't spent into the economy, it hasn't bid up the prices of goods and services, therefore it is not inflationary. On October 25th, the next day, the Treasury issued gold certificates to the Federal Reserve banks, and Treasury deposits at the Federal Reserve banks increased $1.2 billion. Fine, this is also an accounting entry. Thus, the increase in the official value of the gold stock was monetized, or in other words, was available for the Treasury to use to pay for goods and services produced by the private sector. So they still hadn't decided to actually spend it yet, but now they can if they want to. Still not inflationary. The monetary base has not been affected yet. So far, there has still been no net effect on the monetary base, says Berger. Then, over the 3-week period from October 24th through November 14th, the day before the gold bottom of 1973, as the Treasury made payments, Treasury deposits at the Federal Reserve decreased by $1.2 billion, and deposits of the public, the monetary base, and bank reserves were increased by $1.2 billion. So they spent the money into the economy from October 24th through November 14th, but then something happened on November 14th that precipitated the gold bottom. What happened on November 14th, 1973? We have this article from November 15th, 1973, the day of the gold bottom, from the New York Times. Price of gold drops in Europe. Well, yes, it does. This is the very end of the 1973 correction. What was happening on that day? Paris, November 14th. The price of gold dropped sharply in Europe's financial centers today, following the disclosure of the termination by 7 nations of an accord barring bullion transactions by monetary authorities on the free market. The decision, theoretically at least, cleared the way for potentially massive offerings of the metal. Central banks still control half the gold mine since the 17th century. This prospect led to a $7 an ounce fall in prices in London and Zurich, the two major open market centers. Shares in gold mining companies also fell on European and South African stock exchanges. Bullion closed today at around $90 an ounce after reaching levels as low as $86 in hectic dealings. Last July, during a monetary crisis, the metal had reached a record of more than $125 an ounce. While there were conflicting interpretations of the termination agreement, the preponderance of opinion was that it meant a reduced monetary role for gold. The participants, the United States, West Germany, Britain, Italy, Belgium, the Netherlands, and Switzerland, in effect declared their right to sell gold in the markets if they chose. The question of gold purchases is still open, with the United States position declared, but others less certain. So what exactly happened on November 14th, 1973, that immediately preceded the gold bottom of November 15th, 1973, and that was central banks, the major central banks around the world, declared their intention basically to sell gold at free market prices, which they were not allowed to do until that was passed by whatever body was passing it, whatever super electoral or non-electoral body was doing it, some bureaucrat, some deep state thing. But they decided that they were going to do it, and they started to do it. And we see evidence that they started to sell gold. Central banks started to go sell gold that time, November 1973, for the next 6-7 years.
The actual mechanism driving monetary inflation depends entirely on how central treasuries choose to handle structural balance sheet revaluations. In October, the United States Federal Reserve executed an official revaluation of its Treasury gold stock, raising the statutory value by roughly 11% to create a nominal $1.2 billion accounting surplus. While this technical bookkeeping adjustment initially had zero net impact on the domestic monetary base, a massive expansion occurred over the following 3 weeks as the government actively spent that newly minted liquidity directly into the public-private sector. This aggressive injection of capital directly increased bank reserves and expanded public deposits, paving the way for the historic gold bull market that resumed in full force between 2001 and 2011. True long-term price action is determined by individual actors looking to preserve their real wealth from fiat degradation, ensuring that future systemic expansions will drive gold upward. Given the unprecedented scales of modern national deficits and matching balance sheet expansions, gold is highly predicted to break past historical resistance levels and establish an entirely new valuation floor as individual savers completely lose faith in central bank credit certificates. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.